Dear listeners, it is a pleasure to welcome you to Akola Group Investor Webinar. I am Olga from Nasdaq Vilnius and I will be moderating today's event. We will begin with the company's presentation, followed by a short poll, after which we will address your questions. You are kindly invited to submit your questions in writing by using the Q&A window below the presentation or raise your hand to be unmuted after the presentation is over. For your convenience, the webinar is being recorded and replay will be available on the Nasdaq Baltic YouTube channel shortly after the call. Now let me introduce our today's host, Mažvydas Šileika, the Deputy CEO for Finance and Investments of Akola Group. And without further delay, I am handing over to you, Mažvydas. Please proceed.
Thank you, Olga. Good morning, everyone, and welcome to Akola Group webinar for 9 months of the financial year 25-26. It's a pleasure for me to present today for you our performance. And as always, please beware, there might be forward or directly or indirectly expressed views or management assumptions, but they are purely the current view of the management. My name is Mažvydas, and I will present you how Group has been performing for the last 9 months of this financial year. So we always start with the group structure, and this quarter we didn't have any big changes. We have the registered one company, which is Grybai LT. This company was previously merged with Kauno Grūdai, or the activity was merged with Kauno Grūdai, and we have registered the company from the legal entities registration. Rather than that, we are managing 57 subsidiaries and 2 associate companies. Our snapshot for the 9 months looks really well. We have delivered 66 million euros in EBITDA versus 71 million euros last year. Yes, we have a gap of 5 million euros now widening up, so meaning that we're a bit behind the pace of last year. However, we are well above our 5-year average of 54 million euros, and we are really close to our lower bound of our long-term target EBITDA, which is 70 million euros. Our margins remain strong, well above 3%, hovering around 3.6%, a bit less than last year, but that also gives us somewhere a lower valuation compared to last year. We're a bit above 5 times price to earnings, and that's is remaining for the last year or 2 or so. We are quite good with return on capital employed. It has increased. We have well managed our balance sheet. So with a bit less of earnings, we have managed to return more on our capital. And on 12 months rolling basis, we have 33 cents per share earnings versus 25 last year. So on 12-month rolling basis, overall, we look really very good, even though the pace of this quarter was slower, and it seems that last year, especially the end of the financial year, was stronger. Let's discuss our balance sheet. It hasn't changed that much. It's more or less hovering around 1 billion euros. We have a very healthy equity ratio in our trading system. Our borrowing base is 58%, meaning that the rest is equity, 58% is borrowed capital. We are well financed. We have 0.6 billion euros of credit lines available. This year so far we made 29 million in capex. As you probably already know and noticed that this year is much lower in our investment agenda. We don't have such a big projects in our pipeline. Overall, our debt was standing at 386 million, of which 40% was long-term debt. So we are quite well positioned with the long-term debt. The company is not leveraged in management's view, and we have enough capacity to invest or expand further on. That also shows our capital ratio, which stands really strong, 36%. and our 12 months rolling EBITDA is 105 million euros, which provides us with relatively conservative debt level. RMI adjusted net debt EBITDA stands only at 2.6. Without the adjustment, it's 3.35, but overall, it's well above 4 times leverage, and that really is a good performance and result from the group. So, looking at our revenues, they more or less are flat year on year. We have 1.1 billion euros in revenue. Last year we had a very similar amount. The same goes for our tons which we traded. We have only 20,000 tons less traded than last year. So basically, we can say that our revenue performance is more or less flat. However, our revenue decreased a bit more than our tons, meaning that we are still, or we were still operating during the 9 months in more deflationary environment overall. Only food segment, and that's particularly visible in poultry. We're working with rising tons sold as well as rising prices. More or less, other segments we're working in deflationary environment. The share of revenue coming from our food has increased as well, 33% this year versus 28%, and our share of partners for farmers have decreased on the same percentage, meaning that, what I just have mentioned earlier, that we have grown in terms of revenues in our food segment, which was mainly driven by our poultry operations. Let's look at our gross profit, which stands at 133 million euros, which is a good result as we have increased the gross profit by 3 million euros almost. The biggest driver for that was also food segment. They delivered additional 15 million euros, mainly driven by poultry, and the share of our gross profit coming from food has also reached a record high number of 55%. This is a irregular year. It hasn't been that before. You can see the trend was always increasing, but now this year we have actually changed the tide, where we have more income, more gross profits coming from our food operations. Gross profit margin looks really well at almost 12%, more than last year, which was a bit lower, but not that much. So the trend of more profitable business piling into overall group's performance is continuing. Operating profit has a very similar trend in terms of share where we get the operating profit. 96% of this year's operating profit is coming from food, 10% from partners for farmers. There is a big change from last year, which were more or less balanced. However, this year is even more successful for our food operations, mainly driven by poultry. And unfortunately, this year is a bit more challenging for our partners for farmers segments, especially everything related with our trading operations. Last quarter was quite difficult, but it has improved quarter on quarter since the 6 month results. However, with all the geopolitics in the world, there are quite a lot of volatility and unknown things which we have to deal with. However, EBITDA margin looks fine, 3.6 versus 4% last year. So overall, it's a good performance, as well above 5-year average, which is 2.6, and our long-term target is 3%. So we have reached and we are performing above our long-term target. And overall, our EBITDA for 12-month rolling basis looks really good now. If we deep dive into our segments, let's start from partners to farmers. This is still our biggest segment in terms of revenue. As I mentioned before, our sales have decreased in terms of euros, and this is mainly driven by the deflationary price environment. Grains, fertilizers, plant protection, feed and feed components was merely everything traded on lower prices if we compare year on year. In terms of tons, we have a slight decrease in our grains and oilseeds trades, but that's not that big. We have slight decrease in our input trade, and we have more or less flat trade or flat performance in terms of tons in our feed and feed input categories. So overall, you can see that our ton performance is not that different. However, in terms of euros, we have a close to 100 million euros difference, which comes from prices. If we look at profitability, the segment unfortunately delivered 10 million euros less in gross profit than last year. It is a bit more challenging year than last year, and I will tell you more or less what are the main drivers for that. If we talk about grain and logistics, this is one of the segments which delivered better result than last year. That was mainly driven by higher volumes, which we bought through our elevator network. That was the main driver. The quantities we bought in were higher, and that is the main driver for better result. Grains and oilseeds trade, unfortunately, we have 4 million less. However, we have closed the gap since the 6 months result. I would like to remind that it was higher, but as the year goes, we are actively trading through all the quarters. However, the lower profitability is mainly driven by poorer quality of grain than last year. The grain quality this year, since the beginning of the year, was quite challenging, and we were communicating that, and that's of course impacting our result through the year. Of course, the tensions in the Middle East do not help so far. The trading environment is more complicated than favorable for us, but the result overall, I think, is good. Compound feed, feed part is combined of compound feed and feedstuff trade. So compound feed is doing well, year on year performing really good or even better. However, our feedstuff trade has challenges, and the result will remain quite muted due to our unprofitable or loss-making trade in amino acids, which we have already talked last year, and which negative result was accounted with the 6 month result. So all the negative effect is there, but that's unfortunately what delivers us such a big difference year on year in terms of the result. Inputs, I would say flat, and the result is good. The main drivers are seeds and fertilizers. Seed is still one of the strongest positions of Akola Group. We are one of the market leaders. Since this year, we have also seed production in Latvia, which helps us to maintain a solid market position. Fertilizers, we are also maintaining strong position through all three Baltic states. Our stronghold, of course, is Lithuania. We have lost some quantities. However, we are more looking at profitable trades in the fertilizer segment. Machinery is a very mixed sentiment throughout the Baltics. Overall, the result is lower year on year by 2 million euros. The harvest for the farmers was not the most successful one. It was quite moisture. The quality of grain is lower, and it was quite late. So the financial capacity of farmers to invest into machinery, in grain equipment is lower, and we can feel that this year. It's also not that much supported by EU support rounds. That's why we have the lower result, even though probably we could say that the most positive situation is in Lithuania. and Latvia and Estonia has more impact for that, which we see. So let's discuss our food segment. Food production is one of the key segments this year. It's for sure an unusual year where we have so much profit coming from our food operations. Looking forward, that probably will even out. However, this is the segment which also delivered more in terms of sales, and that was mainly coming from our poultry operations, and poultry was the main driver. And fresh meat is the main category sale. This is the biggest one, around 70%. What really helped us and still is helping is our stable cost base, which is actually continuing. So the price and cost gap is favorable for us. Input cost for us as feed and gas remained in line with our expectations. We had more expenses for gas during this winter, which was colder. However, that didn't slow our pace of earnings down. We remain really very focused on biosecurity and operational excellence because the high price environment in Europe, which we operate as we are a very export-oriented company in poultry, remains high, and that's mainly because Poland, as one of the main sources of poultry production, is struggling with avian influenza and other diseases, which doesn't allow to give more supply to the market for poultry. Instant food and ready-to-eat categories. Instant food category is growing in terms of quantity, which is a good sign. We are actually rebounding year on year in terms of quantity and sales volumes. This is a good message. However, market remains really very competitive, and we cannot rebound fast in for profitability. We need to step by step increase our volumes and quantities and work on the profitability in parallel. Ready-to-eat category, maybe less positive note for the 9 months, and that's probably will continue till the end of the year. We have those lower volumes and a bit more higher operating expenses. Volumes are related with slower export markets. One of those are being US. We talked about that last time. That was also some impact from tariffs coming in. However, overall export markets, we need more time to work with them and place our product in the correct geographies for the correct consumers. So we have a lot of focus on pricing, and we have also a lot of focus on sales and ready-to-eat category. Flour and coating systems. So flour is a very stable segment. We don't see a lot of activity there. We more or less place our part of our flour into our internal production. Coating systems, we are continuing to grow, but the growth is quite volatile and bumpy. We have a new factory which we are working with. We need some time to make it work as a well-oiled machine to get the best sales and the margins. Agricultural production, the same story throughout the year and the same topics, which we have discussed, even though we have quite a good harvest in quantities. Milk quantities remain the same. Overall, in terms of revenue, we have lower because both grain prices and milk prices are lower. That's the main driver, and that's what we see in the market for our partners farmers. That also delivered a fewer result, meaning that gross profit of this segment was 3 million euros, which was mainly driven by milk, which delivered 4 million euros, and crops delivered 1 million euros in loss. Of course, we don't account our subsidies, which we received in gross profit, which is around 0.8 million euros. So if you would add that on for the segment, so it is a 4 million euro result. Overall, we're very looking forward already for the next harvest because the crop quality now looks good. We got some rain in the last week. Before that, it was quite dry and challenging. And what is most important driver looking forward are the grain prices. For this segment to increase and boost profitability, we need improving grain prices. We see the trend gaining a bit of a momentum because of the situation in Middle East, but still the increase is only slight, and we would like to see more for this segment. Milk production, so no big changes in efficiency, meaning more or less producing the same amounts. However, milk price, which we sell for, is 8% lower than last year. And since more or less October, the price has been decreasing. And now actually we reached in March one of the lowest price points throughout the year. So we need higher raw milk prices for this segment to improve profitability. So group investments for this year are budgeted to be around 43 million euros. We already have delivered 29 million in 3 months of this year. It might be so that we will finish a bit lower because some projects can be actually carried over to the next financial year to finish, but that amount will not be bigger for sure. If I would like to also remind you, our biggest project for this year is our biomethane production plant in Lukšiai. We have also modernized our two farms, Bartone and Sidabravas, where they will have new milking operations. We're investing quite a lot in poultry to boost efficiency and also to maintain the status of our factories. And another 16 millions will go throughout the group to smaller and bigger things, which are more maintenance or small improvements. We haven't announced any new projects since our last webinar. A few of the projects we are considering, but we haven't made any decision yet. So those are the same. You can see them here. The biggest being new feed production plant, which also would be expanded, which we would move our existing feed production plant from Kaunas to other place. But rather than that, the decision on these projects are not made, and we are in the phase of evaluating and discussing. So thank you very much for your attention. If you haven't registered, please register for our newsletters, and looking forward really for your questions. Thank you.
Thank you, Mažvydas, for the presentation. And now, on behalf of the company, I would like to ask the participants to answer a short poll that you will see on your screens. So it consists only of 2 questions. In the first question, you are being asked to rate the overall quality of the presentation from 0, which is very poor, to 10, excellent. And the second question is asking to share any ideas on how company could improve its investor presentations in the future. So the poll will be available through the Q&A session, but when you answer the question, just close the poll window. So please take a minute to answer these questions, and indeed your feedback would be very appreciated by the company. Yes, and now we can gradually move to the Q&A session. As usual, you can submit your questions in writing through the Q&A window or raise your hand and be unmuted. So the first question that we have received is the following. Could you please elaborate a bit on the crop situation in the Baltic region?
Yes, for sure. So since last week, we got a proper amount of rain, more or less through all the Baltic countries. So the crop situation has really improved and looks good now. Previously, the environment was too dry, and we were actually coming to a point where we could get some damage. But now it really has improved. We have some damage coming from the autumn period when we had some very dry weather. Maybe we will have a bit more summer sowings, spring sowings, but overall the quality looks fine, and fields are actually getting quite improved.
Thank you. And the next question, could you please add a bit more color on fertilizer situation in the region and how it affects Akola?
So for this year, the fertilizer trade and situation is more or less done. We have traded the majority of our quantities in the third quarter. Some remaining trades will be done in the fourth quarter. But all the fertilizers traded were more or less bought before the situation escalating in the Middle East. So this year it will not be affected that much as the price dynamics were already more or less fixed. However, the biggest challenge is looking forward to the next financial year, because this is the moment where should start ordering fertilizers and forming our positions in this trade and be ready to supply the farmers. However, there is really felt lack of physical supply in the market, so it is harder to get physical supply of fertilizers in the market. We need to be more creative here. And that will continue if the situation in the Middle East will not change. Also, the price dynamics are really unknown for the next periods because the gas price remains really a question, and not all of the participants and factories in the market are ready to buy the gas for the price and produce. So for this financial year, I see no major issues. However, looking forward, we will need to be very cautious and make the right trades. We also see that farmers are looking at the fertilizer price, which has increased quite a lot for the next period. It doesn't correlate yet, doesn't correlate with the crop price, with the grain price, and they are also cautious to buy fertilizers. So it looks like they will fertilize the fields less, basically also doing some risk management on their side. So they can fertilize less in autumn. However, spring is very crucial to apply as much fertilizer as possible to have the best potential of the harvest. And that decision they will have to make in October, November.
Thank you, Mažvydas. And now a few questions also related to fertilizers. Perhaps you have covered them partly, but maybe you can add something. So did you stock up on fertilizer before the new year due to the changing import regulations?
Yes, that is very correct. We have brought in all our fertilizer position for this spring before the end of December 2025, because after December, the carbon adjustment mechanism takes action, and we were not sure, and the market was not sure how it will be calculated. Will it not be canceled? You know, how we have to form the prices, how much we will pay. Everything was really very vague and not specific, especially that we saw a lot of instances when the European Commission has changed their mind and canceled something, and that makes a lot of damage for us. So we were very cautious. We bought all the fertilizers before all the adjustment mechanism takes place. So we have formed our position for spring, and we have traded that with less risk for any taxes coming from that. So that is sorted out. We also had all the position formed more or less before the prices increased in the market. And for this year, as I mentioned before, there won't be a lot of effect coming from that. But next year, of course, is challenging in this area.
Mhm. Thank you. And then the next question also relating to fertilizers. Given the fertilizer and grain prices have started rising since early 2026 and still going up, is your company benefiting more from trading, or does a price increase not guarantee higher profits?
Overall, increasing prices for the group is a more positive thing than negative thing. However, it really depends how we form our position. So it's not a very straightforward question. I will not talk anymore about the spring. Probably more or less I explained that for the around the fertilizers. But looking forward, we need to be cautious of the price we buy because we buy it in our warehouse, we stock it up, and if the price suddenly decreases in the market, we are then selling our inventory for a lower price or smaller margins. So we need when we buy up, when we stock up, when we form our position, we then need the same level of market prices or increasing market prices to benefit from that. So it's not easy because the price is moving both directions and both ways. We buy now fertilizer if the Strait of Hormuz and the Middle East situation somehow gets solved. We could see drop in gas prices, and that will result drop in fertilizer prices, and that could have a negative effect on our position in the warehouse. So how we form and how we sell to the farmers is a bit of a quite a big effort and risk management on our trading portfolio.
All right. And how do you see potential fertilizer supply disruptions going forward? How is the supply situation?
As I mentioned before, it's challenging. It's difficult. We need to be more creative. We need to find new suppliers in the market. What you can read in the news that there is lack of fertilizer components, different chemicals. This is really felt in the market. Some plants are even not working because they cannot get hands on particular chemicals for their production. So of course, the other side, the demand for fertilizer is also dropping as the price is, at least for now, too expensive for the farmer. So the demand and supply of fertilizers will reach somewhere, in between. But overall, challenging situation going forward for sure. We are monitoring that very accurately, and we are looking how to secure our supply going forward.
All right. Thank you. And the next question. Could you please share your insights about farmers? They seem to be hit by surged fertilizer prices and more expensive fuel on the one hand, but on the other hand, wheat prices are up by around a third since the start of the year. So what could be the net effect?
The net effect so far, I would say, is more negative than positive. We need to see a higher, bigger increase in grain prices than we saw so far because we are growing or increasing from a very, very low level. As you can see that last 2 years, grain prices are not profitable for us. It is the same for the whole industry, for the whole farming segment. So we are growing from a very, very low background. But you are right. There is a positive trend so far with the grain prices, and that's mainly now driven by, of course, a bit higher fertilizer prices. But the main driver is now the forecast of possible global harvest for the upcoming season. And so far, the crop quality looks worse than better in US. So that drove the price a bit up. It also some quality of crops is not that good in eastern part of Europe, Russia, Ukraine as well. Now it is raining. Maybe it will be fixed. So we need to see the next report. But that was more of a bigger driver for price increases of grains, basically saying that the future harvest forecast from that particular point in time was a bit worse than last year. So that was anticipating a lower harvest, global harvest, which then was started driving the prices up. But of course, when you look at the input side, fertilizers are increasing, diesel price is increasing, labor is increasing. So, and that increased overnight, meaning that diesel increased overnight, fertilizers increased overnight. and grain prices are propping up only bit by bit. So we will see how that equilibrium will end up, and we will see how it will go. As far as now, the net effect is still around zero or negative, but not yet positive.
Moving to the next question. 9 months EBITDA is at euro 66 million. At the same time, you indicate EBITDA at the lower end of the 70-90 million euros range for the full fiscal year, which effectively implies a single-digit EBITDA for the fiscal quarter 4. Could you please add a bit more texture on the weak expectations for the fourth quarter?
Well, it's we actually communicated to the market, and we did not change our long forecast for this year. We remained it at 70 to 90 million euros. We said that so far with 6 months we are at pace with last year. However, we wanted to wait for the third quarter to see if we are keeping the momentum or we are falling behind. So we never communicated that this year can be up to a bigger range that we have communicated before. So we were keeping the 70 to 90 million euros. Because we saw that there is volatility coming up in the next quarters, especially in trading operations. Harvest quality was low, and we needed to see how it goes. So our message is very clear that with our 9-month results, we already reached our lower bound of our targeted EBITDA range, meaning we reached already 70. So with the fourth quarter, we are not changing, and we are presuming and seeing that we will end up our financial year somewhere in between our targeted range of 70 to 90 million euros. If during the fourth quarter we will see that the situation is far better or more or less the same. So if it's better, we will communicate accordingly to the market that we are doing better. If we will see that we are more or less in the range, there will no be extra communication from us as the range keeps up. So I would not say that our fourth quarter is weak. I would say we have a good regular year for the group, because if we do closer to 90 million euros of the range, I would say it's a strong year. Last year was the second best year in group's history, so it's not easy every year to reach a new record. So I would say we are in a good pace. What would really help that our investments which we made in food segment would start operating and deliver the result according to the business plan. That would allow us to increase the range permanently. But for that, as we have seen for all the year, we still need to work hard.
Thank you, Mažvydas, for the explanations. And I see we still have a number of questions to answer. So the next question: what is the current condition of the winter crops this spring?
I probably touched upon that question. It looks good after we got the rain and humidity. It is a good condition for the Baltics.
And which market or commodity factors do you expect to have the biggest positive and negative impacts in the coming quarter?
Commodity markets, of course, we would have. We are following gas prices quite closely. We are using them less in our production in the fourth quarter, but it's also a big driver. Anything related with our feed components, meaning soy meal prices, grain prices, would also have a big impact. Fertilizer trade will be more active next financial year, first quarter, so that will not have a huge impact going forward. So those are the things. Milk prices would really help. which in the fourth quarter, but they are not moving that fast. But raw milk prices, which we sell for, is really important. Probably what you're not following that much, but we always provide in our reports is the poultry chicken fillet market price in Europe. That is a very big driver for poultry, and we're actually looking at quarter by quarter, and you can also follow that to see what is the dynamics of our poultry operations and profitability.
Thank you. How is the sale of the certified carbon credits progressing, and what has the market demand been like so far?
So we haven't yet sold our carbon credits. We have just recently received them. Now we are in the progress to market them and sell. They are definitely a liquid position. We are looking to get the price, more or less what we planned when we went into this project, but we haven't yet sold them.
All right. Next question. Shall we expect the usual seasonal reduction in ready marketable inventory in fourth quarter compared to the quarter three?
I would say that would be the best assumption going forward.
Okay, let me see if we have more questions. It seems that we have covered all the questions so far. But if any of you still have a question to ask, please do so now. Just write it down in the Q&A window, or you can raise a hand. Okay, I see one more question coming in. What was the key driver of quarter three gross profit decrease? Oh.
I would maybe not say that there is one main driver. Probably our gross profit overall for the 9 months remained higher by a few million euros. So we got that more on that. But the drivers, I would say, are more or less coming from the partners for farmer segment. You can see that almost all positions are lower compared to last year. We also, year on year, we probably didn't talk about that much, but cost is also piling up pressure, on the profit and loss statement. We have increase in labor, we have increase in fuel prices, we saw increase in gas prices for our production. So that is also a pressure which is building up in our P&L. Maybe they are not yet the biggest drivers. We are lower on the earnings part as well, but that cannot be ignored as well. That also is piling up on the P&L. We are operating in a higher cost environment than last year.
And one more question. Could you please comment on the approximate price range you're planning to sell the credits for?
Unfortunately, I would say that's our confidential information, and we're not communicating that.
Okay, thank you. Understandable. And yes, I don't see any further questions. It would seem that we are good. So we have covered all the questions. So, and thank you once again for answering our poll. It's really appreciated by the company, your feedback. And now, just on behalf of the Akola Group and Nasdaq Vilnius, I would like to thank all the participants for your time and indeed very active engagement. And we will be looking forward to seeing you in our future events.
Thank
Thank
you
you
much.
once again. Yeah, and goodbye.
Goodbye.